Imagine opening your mailbox today and finding a formal collection notice,
Yeah.
but it's for like a pizza you ate back in 1996.
Oh, man, that would be completely ridiculous.
Right. It's absurd. Now imagine that single piece of mail, that ancient pizza bill,
Hmm.
somehow causes thousands of investors to just completely panic and sell your company's stock.
Yeah, it sounds like some bizarre thought experiment.
It really does, but that is essentially the reality we are looking at today for a major IT services firm.
And, it really highlights the sheer irrationality that can just grip financial markets sometimes. Because when you look at a company, there is the fundamental reality of the business, right? Like the actual cash they generate, the services they provide.
The real stuff.
Exactly, the real stuff. And then, completely separate from that, there is the psychological reality of the stock price. And right now, for this particular company we're looking at, those two realities are living on entirely different planets.
They really are. So welcome to today's deep dive. We are putting Expleo Solutions Limited under the microscope. You might see them listed under the ticker Expleo Sol. They are this highly specialized IT services firm, and they focus heavily on software validation.
Yeah, and our mission today is to figure out this really fascinating corporate paradox for you.
Right, because we are looking at a company boasting a massive 21% return on capital employed. They're paying out a very juicy 6.5% dividend yield.
Which is huge.
It's massive.
Mm.
And yet, if you look at the chart, you are watching its stock just absolutely plummet. I mean, going from rupees 1,250 down to rupees 755 in just a matter of months.
Yeah, it's a brutal drop.
Yeah.
So to decipher this, we've pulled together a really comprehensive stack of sources for you. We are going to cross-reference Expleo's Q3 FY26 earnings presentation, which covers up through December 31st, 2025, with a 12-month news coverage analysis that ends right around now in April 2026.
And then we're layering some technicals over that, right?
Exactly. To really map out the market's psychological state, we are layering over a very recent technical stock chart analysis.
Okay, let's unpack this. Because if we want to understand why investors are just slamming the sell button, we first have to establish the baseline reality of Expleo's actual bank account. Like, what is happening under the hood of the business itself?
Right, the fundamentals.
Yeah. Let's dive into the financial top line first, because honestly, the revenue engine looks like it is humming along perfectly. Operating revenue for Q3 FY26 was rupees 2,794 million.
Yeah, which is an 8.5% increase year over year.
Right. And total income hit rupees 2,897 million.
And zooming out to the 9-month picture gives us an even clearer signal, I think. The 9-month data, the 9M FY26, shows operating revenue sitting at rupees 8,217 million.
So that's almost 7% growth, right?
Yep, a 6.9% increase year over year. So the core operation of the business, actually acquiring clients, billing the hours, bringing money in the door, is demonstrably growing. I mean, they are clearly not losing market share.
But then, we hit the bottom line, the actual profit,
Oh.
and suddenly the whole narrative just derails.
Yeah, it gets messy.
Very messy. The Q3 profit after tax, the PAT, took a massive hit quarter over quarter.
Mm-hmm.
In Q2, they were sitting at a profit of rupees 431 million. That's a very healthy 14.6% margin.
Which is great for IT services.
But in Q3, that profit drops down to rupees 234 million. The margin just shrinks to 8.1%.
Yeah.
Basic earnings per share just plummets from rupees 25.62 down to 14.26 in that exact same time frame.
What's fascinating here is the mechanism behind that drop. Because, if you just stop at the headline EPS, it looks like the core business model suddenly failed, like they just drove off a cliff.
Right, like clients suddenly stopped paying them or something.
Exactly. But when you dig into the actual footnotes of the financials, you find this quote-unquote exceptional item. And it resulted in a rupees 167.9 million $0.9 loss. The company cites a labor code impact.
Okay, wait, let's unpack that because labor code impact sounds incredibly vague.
Mm.
In the IT services sector, your primary inventory isn't like warehouse goods or raw materials. Your inventory is human capital. It's people.
Yep.
So does a labor code impact mean they suddenly had to pay their engineers some massive premium to stay competitive? Or is this just, an accounting adjustment?
It is almost entirely a regulatory and accounting adjustment.
Okay.
Yeah. So when a jurisdiction overhauls its labor codes, which, by the way, we've seen a lot recently with new wage codes and Social Security regulations, companies are forced to recompute how they provision for things.
Like what kind of things?
Yeah, things like accumulated leave encashments, gratuities, provident funds, all those back-end benefits. And because Expleo has a massive workforce, even a minor change in how a single employee's benefits are legally calculated gets multiplied across thousands of payroll records simultaneously.
Oh, wow. So it just balloons instantly.
Exactly. It triggers a massive one-time retroactive charge on the balance sheet.
So it's not that they are suddenly bleeding money operationally. If we strip out that one-time regulatory charge, what does the actual operating profit look like?
It bounces right back up.
Huh.
Excluding that exceptional item, the profit after tax margin sits at a much healthier 13.9%. So the core profitability of the actual services they deliver to clients remains totally intact.
Okay, so you're telling me the underlying profit is stable. But let me push back here a little bit. As a prospective investor, right, you're looking at a stock chart that's just bleeding out.
Mm.
Do you just brush off a rupees 168 million hit as a one-time accounting quirk? Like if you own a highly successful restaurant and sales are up, but suddenly you have a massive plumbing emergency that wipes out the quarter's profits, you just say, oh, it's a one-time fix. Or is it a sign of leaky pipes throughout the whole house?
That is the exact core debate right now.
Because if they employ thousands of people, labor compliance isn't just a one-off issue, is it? It's a structural cost of doing business.
Right, and fundamental analysts will argue exactly that. While compliance is a structural cost, a sudden legislative overhaul that requires retroactive provisioning, that is a one-off event. It doesn't mean their software validation contracts are silently less profitable.
But the market didn't see it that way.
No, because you have to remember algorithmic trading models. They drive a massive percentage of daily market volume now, and they are not designed to debate labor law nuances or read the footnotes about leave encashment.
They just read the big numbers.
Exactly. Their scraping tools see a headline EPS drop from 25 to 14. They register a massive negative divergence from historical averages, and boom, they automatically execute sell orders.
So the algorithms see the headline drop and they just dump the stock.
Yeah.
But what about the actual cash in the vault, like the real money the company holds?
That is the ultimate counter-argument to the algorithms right there. Expleo's net cash position is incredibly strong. They are sitting on rupees 3,892 million in cash.
Wow.
Yeah, and that's actually up from rupees 3,030 million in the previous quarter. So despite the paper loss on the bottom line that completely spoofed the market, the actual cash reserves of the company are growing significantly.
Okay, so the fundamental business is bringing in cash, despite the headline profit hit. That means we really need to look closer at what this machine actually does. Where is this 8.2 billion rupees in 9-month revenue actually coming from? What is their day-to-day operation?
Well, they are a highly specialized firm. Their core focus is software validation, and their domain is overwhelmingly concentrated in one very specific arena, which is BFSI.
BFSI, so banking, financial services, and insurance.
That's the one.
When you say overwhelmingly concentrated, I mean, that is an understatement. Looking at the data, we are talking about 80.2% of their Q3 revenue coming strictly from that BFSI sector.
It's massive.
Aerospace is a super distant second at 10.6%, and automotive makes up just 8.8%.
And you know, their geographic reliance is equally concentrated. Europe is the massive engine here. It drives 55.4% of their total revenue.
Over half just from Europe.
Yep. Asia is second at 32.1%, and North America is pulling up the rear at only 12.5%.
Okay, let's focus on the why here. Because
Yeah.
why are European banks relying so heavily on Expleo for software validation? The data highlights that digital revenue accounts for 53% of Expleo's total revenue. That's rupees 1,467 million just in Q3. So they aren't just, maintaining old mainframe servers from the 1990s in a basement somewhere.
Oh, far from it. European banks are undergoing these massive, totally forced digital transformations right now. They are trying to integrate legacy core systems with modern mobile apps, open banking APIs, real-time payment networks. It's a huge undertaking.
And Europe has crazy strict rules about that, right?
Exactly. In Europe, the regulatory environment around financial data is arguably the strictest in the world. If a European bank rolls out a software update and an API fails, say it misroutes transactions or, even worse, exposes clients' data, The regulatory bodies don't just issue a polite warning.
Right, they don't mess around.
They hand down catastrophic multi-million euro fines.
So the cost of a software bug in a European bank is astronomically higher than, say, a bug in a retail shopping app.
Precisely. And that is exactly what software validation is. Expleo isn't necessarily writing the core banking code itself. Their 3,541 delivery employees are rigorously stress testing that code before it ever touches a live server.
Oh, I see.
Yeah, they are simulating millions of transactions, they're finding the vulnerabilities, ensuring regulatory compliance. You do not hand that level of systemic risk to some generalist IT firm that usually builds e-commerce websites. You hire domain specialists.
That makes total sense, and that explains why the data shows they have 30 clients generating over $1 million each.
Right.
But you're telling me domain expertise allows for premium pricing, which sounds great on paper. Yet, if you look at their client base, they only have 85 active clients. And their top 10 clients contribute 55% of their total revenue.
It's a tight circle.
I mean, to me, I have to challenge you on this. That doesn't sound like a superpower of hyper-specialization. That sounds like a massive vulnerability. If 80% of your revenue is tied to banks, and over half is from just 10 clients, one lost contract could tank the entire quarter. Has that kind of concentration risk burned them?
Well, it's the classic double-edged sword of enterprise IT services. You are absolutely right that having 55% of your revenue tied to just 10 European banking clients is a structural risk. It's something any investor has to model for.
Because if Europe catches a cold, Expleo gets pneumonia.
Exactly. If the European macroeconomic environment deteriorates further and those banks suddenly freeze their IT budgets, Expleo gets hit immediately. They don't have a massive retail or healthcare portfolio to act as a shock absorber.
They're completely exposed to the European financial weather.
They are. However, the counterargument, and this is crucial, is the stickiness of the revenue.
Stickiness.
Yeah. Once an IT services firm is embedded that deep inside a bank's compliance and validation workflows, ripping them out and replacing them with a cheaper competitor is viewed as an unacceptable operational risk by the bank's own risk managers.
Because if the new guys mess up, the bank gets fined.
Exactly. The switching costs are monumental. So while the concentration is really high, those top 10 contracts are historically very, very resilient.
Okay, so let's summarize where we are. We have a fundamentally profitable, cash-rich company. They're highly specialized, executing these sticky, mission-critical contracts for major European banks, even if their client list is a bit top-heavy.
Correct.
So if the core business has generated all this cash, who is actually hitting the sell button? Like, what is spooking the market so badly? Let's transition to the news coverage from April 2025 to April 2026. Because if the balance sheet is the signal, the headlines seem to be driving all this noise.
Yeah, the headlines have not been kind. Over the past 12 months, the broader IT sector has been under immense pressure generally. We're seeing underperformance and multiple compression across the board, and Expleo has simply been dragged down with the tide.
Just guilty by association with the tech sector.
Pretty much. The news coverage notes the stock has taken a 4% to 25% hit over the past year in various cyclical waves, just following the broader sector trends.
Right, because when the entire sector is out of favor, institutional investors will just systematically reduce their exposure to IT stocks, completely regardless of individual company performance.
Exactly. They just sell the whole basket.
But then you layer in specific operational headlines that get completely warped by a jittery market. For example, in February 2026, Expleo closed their Coimbatore Competence Center, and they consolidated those operations into their Chennai hub.
Which, honestly, from a purely financial perspective, is practically irrelevant.
How so?
The sources note that the Coimbatore Center contributed a negligible 0.05% of total revenue.
Wait, 0.05%. That's literally a rounding error. It's essentially meaningless to the bottom line.
It is, and the funny thing is, in a bull market, a headline like that is spun as, management brilliantly optimizing their real estate footprint and increasing margin efficiency by shifting talent to a Tier 1 hub like Chennai.
Oh, for sure. Streamlining operations.
Exactly. But in a bear market, when sentiment is already deeply negative, that exact same headline is interpreted as a company shrinking its operations just to survive. Confirmation bias totally takes over.
Wow. But, the Coimbatore closure is nothing compared to the ghost from the past that showed up that exact same month. Here's where it gets really interesting. In February 2026, the EPFO, which is the Employees Provident Fund Organization in India, issued a notice to Expleo for alleged dues dating back to the period between 1996 and 2010.
Yeah, for a total of approximately rupees 5.5 million.
Okay, this is where we get back to our 1996 pizza bill analogy from the intro. I want you, the listener, to really think about the absurdity of a regulatory body demanding rupees 5.5 million for alleged administrative discrepancies that occurred up to 30 years ago.
It's wild.
And more importantly, why would the market react to this? I mean, a 30-year-old bill.
Well, if we connect this to the bigger picture, the market's reaction has absolutely nothing to do with the rupees 5.5 million itself. I mean, we already established they are sitting on rupees 3.8 billion in cash reserves.
Right, they could pay that fine out of the interest generated by their cash pile in, like, in a matter of days.
Exactly. The reaction is entirely psychological.
So it's about what the headline represents to, say, a foreign institutional investor sitting in New York or London.
Yes, markets can price in bad news, but they aggressively discount uncertainty. When an algorithm or a portfolio manager sees a headline about retroactive regulatory action in an emerging market spanning a 14-year period, the immediate question is always, what else is hiding in the closet?
Ah, right. It breeds paranoia.
It feeds into a much broader narrative of regulatory unpredictability. So even though this specific notice has absolutely zero bearing on their ability to validate software for a European bank today, it creates a psychological drag on the stock.
Which brings us to the ultimate showdown of this deep dive, the great disconnect. Let's compare the fundamental reality of the business against the stark reality of the April 2026 technical stock chart. Because while the fundamentals show all this growth in cash, the chart is just brutal.
It really is. It is a textbook bearish trend. The technicals show that after peaking near rupees 1,250 in late 2025, the price action has just been bleeding out. As of early April 2026, it is hovering around rupees 755.
When you look at the chart, it's trapped in this downsloping channel with just multiple red candles. It's a series of lower highs, which basically tells us the sellers have been in complete control for months.
Yep.
Every time the stock tries to stage a minor rally, trapped investors use that liquidity as an exit door, and they slam the price right back down.
But, if we look closer at the momentum indicators, there is actually divergence forming.
Okay, explain that.
So the RSI, the Relative Strength Index, is sitting right around 51 to 54, which is effectively neutral. And that's happening despite the massive downward pressure on the price.
Wait, so the RSI is hovering at neutral, around 51 to 54, despite the massive price drop. That divergence tells us the aggressive dumping has largely dried up, right?
Exactly.
The people who were panicked by the labor code impact or that weird 1996 EPFO notice have likely already exited their positions.
Right. But, crucially, no institutional buyers are stepping in to catch the falling knife, which leaves the stock to just drift downwards.
Adrift in the ocean.
That's exactly what the tape is showing. The technical support, basically the floor where buyers have historically stepped in because the valuation just becomes too cheap to ignore, is clustering right around the rupees 735 to 750 zone.
Okay, so that is the technical reality, a broken chart with dried up momentum. But then you look at the fundamental analysts, and the cognitive dissonance is just staggering. Analysts are projecting wildly bullish targets for this same stock.
Oh yeah, they love it.
They were looking at an initial target of rupees 1,522, and some project it could go up to rupees 2,130 by the end of 2026. That is nearly triple the current trading price.
And their modeling is entirely detached from the technical chart. Fundamental analysts are looking at that 21% return on capital employed, which shows management is highly efficient at generating profit from their core assets.
They don't care about the chart's downsloping channel.
Not at all. They are looking at the fact that Expleo has been aggressively reducing its debt, they're cleaning up the balance sheets, and they are heavily weighting that 6.5% dividend yield.
Wait, let's talk about that 6.5% dividend yield for a second, because if a stock is tanking, isn't a high yield usually a value trap? Like a company paying out cash, it doesn't really have just to artificially prop up the share price? Or is this actually a case where investors are being paid to be patient?
Well, a high yield is a trap when it's funded by taking on new debt or when the core revenue is collapsing. But we know Expleo's 9-month operating revenue grew by almost 7%, right?
Yeah, we covered that.
And their cash position actually grew to rupees 3.8 billion. So
Yeah.
the dividend is fully covered by actual, real operational cash flow. Management is essentially signaling to the market, hey, we know the stock price is depressed, but our bank accounts are full. So we're going to return that cash directly to the shareholders who stick with us.
So what does this all mean for you, the listener? It really feels like we are watching a tug of war. On one side, you have these fundamental models coldly analyzing the company's reality, the cash, the dividend, the revenue growth in Europe, and screaming that this is deeply undervalued, like a supercomputer saying buy.
Right.
But on the other side, you have the technical reality, which is driven by human panic, algorithmic scraping of accounting footnotes, and IT sector headwinds, just aggressively smashing the sell button.
And as an investor, you really have to synthesize both of these realities. You cannot fight the tape. The technical chart proves that the short-term trend is undeniably bearish. There is heavy overhead resistance built up between rupees 944 and 1,000.
Resistance from what?
Well, that zone is filled with bag holders,
Yeah.
investors who bought near the top and are just desperately waiting for the price to recover so they can sell and just break even.
So the moment it goes up, they sell, pushing it back down.
Exactly. It's going to take a massive catalyst of buying volume to break through that ceiling.
So the fundamentals provide the floor, but the technicals provide the ceiling.
Yes, exactly. The fundamental valuation suggests the stock is totally mispriced, but the chart dictates the timing. If you are watching this, the immediate action is to really monitor that rupees 735 support level. If that floor holds, we might finally see the fundamental realities start to pull the rope back from the technical momentum.
It is truly a tale of two realities. To summarize, Expleo Solutions is a highly specialized, deeply profitable tech firm. Yes, they face structural concentration risks by relying so heavily on European banking clients.
For sure.
And yes, they had to absorb a localized labor code accounting hit. But the actual mechanism of their business validating mission-critical software for financial institutions facing massive regulatory scrutiny is sticky, it's growing, and it generates an absolute mountain of cash.
And contrasted against all of that, you have a deeply pessimistic short-term stock chart, which is just dragged down by macroeconomic dread and the psychological noise of completely immaterial regulatory notices from 30 years ago.
Which brings up a really critical tension for anyone managing their own portfolio, and it's a puzzle I want to leave you, the listener, to mull over today.
Yeah, think about this. When an entire market aggressively punishes a stock based on broader sector fears, completely ignoring a fully funded 6.5% dividend yield and consistent revenue growth, at what point does following the technical trend cross the line from smart momentum trading into outright irrationality?
That's the real question.
If the underlying business is generating more cash than ever, but the stock chart is completely broken, are we witnessing a broken company, or are we simply witnessing a broken market?
That is the ultimate question when fundamentals and technicals collide. Thank you for joining us on this deep dive. Keep questioning the mechanisms behind the headlines, trust your own analysis of the data, and we will catch you on the next one.